it does have dangers. You should leave it alone. And that is the essential bar of professionalism, representing the person sitting in front of you. And the more we have sight of that as an industry and as a profession, the less scandals we'll have, the cleaner we'll be. Try not to bring sophisticated things down to a retail standard.
Welcome to Heart of Wealth, your weekly pulse check on the wealth industry. I'm Will Robbins, your host for this week. Today on the show, national wealth firm St James's Place has hired 2 ex-police officers to investigate any advisor misconduct. The Swiss regulator has sounded the alarm on significant losses to retail clients. And Swedish wealth group Söderberg & Partners has placed a £280 million bid for Benchmark. Joining me today are 2 Citywire journalists, Jack Gilbert and Laura Purkess, plus James Roberts, CEO of international financial advice firm Blevins Franks. Hello to you all.
Hello.
Hello, hello, hello. What do we have here then? We have our first story, which is SJP has hired 2 ex-police officers to investigate potential misconduct. Laura, you wrote this story with fellow NMA reporter Julian. Where did this story come from and what is going on?
So I won't know who it was from, but it was from a tip last week. Someone tipped me off that SJP had hired a couple of police officers to look into advisors. There's a lot of kind of concern about when those police officers will be looking into them and what that meant. But there's still a lot of speculation around that. But what I did then was go onto LinkedIn and I found a couple of police officers who'd been hired in the past year. And then we found a job advert for an investigative role where they were looking into advisor misconduct. And I think it said there had been a kind of new misconduct unit that had been set up around September, October last year. So that's how we got the story.
Just explain a bit of context around this. Why is this important, this story, and what kind of impact has it had on the audience of advisors?
I think it comes at a really interesting time for SJP as a business. Obviously, over the past year, charging structures changed massively. It's had a lot of regulatory scrutiny. So to kind of bring this in now, it's kind of saying to its ARs, we're putting this on you. We're monitoring you because they don't want any more of this going forward. And we are seeing a lot of advisors leaving the network at the moment as a result of some of these changes. The clampdown, changes to fees. It's making it just a bit of a different and a more difficult time to be an SJP partner.
James, is this something you've ever seen before, working in advisor networks and wealth firms?
No, but I really quite liked it actually.
Okay.
It comes back to this idea of what are the police actually for you? So we've got a little bit confused around that over the last few years. The police have been knocking on doors and looking at all sorts of different things. Actually, if you go back to the idea that you want your society to function well and the police are there to be a barrier to that, who is better qualified to investigate misconduct than people who are from the police? So
to be clear, these are former police officers.
Former police officers, yes. But they've got a methodology and a rigour that they bring to an investigation because they've been doing all that their life. And I think as an industry, as a profession, it doesn't help us with what we're trying to be, which is the guardians and assistants of people's money, if the biggest player is tarnished by a bad reputation. So to see St James's Place starting to take steps like this in the right direction, it's really encouraging.
That's interesting.
I think one point as well is that obviously SJP have over 5,000 advisors, which is kind of almost like a fifth of the UK market. So what people often say, which I think is a fair point, is that there's always going to be a few bad apples if you've got over 5,000 advisors within the network. But obviously what was interesting about the story is potentially the public advertising they did in order, to try to stop some of these the bad actors within the group.
Okay, I will perhaps move on to a second story, which is another great scoop for Citywire, revealing that Söderberg & Partners had submitted an offer to buy a business called Benchmark Capital off UK asset manager Schroders. As we said, the bid was £280 million. Jack, you've been covering the sale of Benchmark for a while, so could you put us in the picture? What is the business and why is this sale significant?
So Benchmark Capital is an advice business which is owned by Schroders, as you said. It's an advice network, so advisors run their own small businesses under the Benchmark umbrella. It also has an investment platform and quite a lot of advisor tech, advisor back office systems and other bits of advice tech. And we've seen it since Schroders came in. I think in 2016 they first invested. We've seen it growing quite a lot in that time. I think it's up to kind of 20 billion assets plus on the platform at the moment.
Right, let's talk about Söderberg. This is a Swedish business.
Yeah.
Why does it want to buy a UK wealth firm then?
Good question. Well, Söderberg and Partners, they're backed by private equity firms, TA Associates and KKR, very big private equity firms. They've got a big presence in the Nordics. They came into the UK market a few years ago, and they've been buying up stakes in lots of small advice businesses. Lots of former LMA cover stars have sold stakes to Söderberg. So they've been expanding kind of gradually, but they've not built up a huge presence yet. So this would be quite a sizable kind of a deal for them, and would certainly elevate them up in terms of their presence in the wealth space. In terms of why they want to buy Benchmark, I mean, look, I think Benchmark is very well respected in the industry. Lots of really good advisors work there. Has a good kind of reputation for the quality of the advisors it's got. And this would significantly add scale to their presence in the wealth space. And I guess it's further examples of the appetite for private equity in the UK market.
James, so you sold the business you founded, Partners Wealth Management, in 2020. What are going to be Benchmark's main considerations here? Is it all about who the highest bidder is, or something else?
Well, it's not Benchmark who are the ultimate decider. It's Schroders who are ultimately going to decide who the right partner for them are. I think what's interesting is more the Söderberg piece, because they've come in and they take smaller stakes into advice businesses and then offer them a tech stack. And so you can see why they're interested in the Benchmark, because it's still really the only completely designed back office system and platform integrated into one, designed from day one together. So if they can take that and add that into some of their tech stack already, as well as the advisor network from best practice, that becomes quite an interesting thing for them. So there is this question, there's always the value to the seller, but is that a good outcome for the advisors or the interest? Yeah, you can see how that really can be a better partnership.
Thank you very much. Now we'll move on to our third and final story, and this one comes from Switzerland, so keeping the international theme going. The Swiss financial regulator, FINMA, has put wealth managers there on notice, it seems, publishing a report which basically says firms have been selling high-risk, illiquid and complex products to people they should not have been selling those things to. So that is to say, retail clients. And it's not kidding. According to FINMA, the number of cases escalated to it totaled 8 in 2023, but in 2025, that number was 68. James and Laura, I'm going to bring you in on this. James, I suppose I'm going to firstly ask you, are European regulators like FINMA here catching up on where the UK has been for a while, do you think?
Actually, the RDR and then Consumer Duty really set the tone in a very, very positive way. You are there to advise people on how they accumulate their wealth rather than drive out your product. And that's got to be the way of any professional service. It represents its client, not not the product companies within it. So yes, Europe is catching up to that extent. And then in this specific case, we've seen this in the UK so many times. Everything that often goes wrong in terms of scandal comes from liquidity. Whether it's commercial property funds, whether it's selling of in-house product that isn't then immediately liquid, whether it's structured products. All of these things, and that's what are now starting to come home to roost in portfolios, are these things in the best interests of the client?
Laura, I mean, my question to you is, would you be surprised to hear the UK regulator talking about these things still if it puts something like this out today?
Not at all. Something that seems really obvious that springs to mind from what you were just saying about liquidity is the democratization of private markets we're kind of seeing in the UK at the moment with retail investors. There's been a really big push to kind of get them into these products through long-term asset funds, and quite a lot of the platforms have been getting into those, like Schroders and Hargreaves, and that it feels like this is something that's going to come out in a few years as a lot of people getting into those who shouldn't have been. And while no one's necessarily doing anything wrong, it feels like there is something waiting to happen on that.
I think I noted lastly on this. I noted, FINMA was talking about retail clients, and so trying to distinguish between them and what you might call your sophisticated clients, your ultra high net worth.
Yeah.
I mean, again, Laura, you've written lots of personal finance stories. Is this something that regulators have got right, sort of understanding sort of the vulnerabilities of people, or how sort of the person on the street, so to speak, needs to be dealt with?
We've seen recently all of this kind of push, I actually think, from the government to get more people to invest, and if anything, that could create more of these problems, because the average man on the street who you would talk to writing for somewhere like The Sun knows, we might have retail investors who don't know very much, but they're interested in investing, and then you've got your sophisticated. But your person reading The Sun, a lot of them have next to no knowledge of this stuff. And so where do you put someone who doesn't even understand the difference between active and passive, or an ETF? They don't know what any of these things mean. Sorry, were you going to come in?
Yeah, this links back to right what we were talking about at the start, about
the policeman
and advisor integrity. There is a difference between a retail client and a sophisticated client. But what happens is that human beings who are retail clients get interested in sophisticated ideas. And if your advisor is a professional, it's the job of the professional to say, actually, no, that brings in risk for you that you don't need. And rather than acting as a salesperson going, yes, you want this shiny, sophisticated product, which is for people with £5-10 million, actually, it does have dangers, you should leave it alone. And that is the essential bar of professionalism, representing the person sitting in front of you. And the more we have sight of that as an industry and as a profession, the less scandals we'll have, the cleaner we'll be. Try not to bring sophisticated things down to a retail standard.
Thank you very much. That's all we've got time for today. A massive thank you to our production team and to our guests, Laura Purkess, Jack Gilbert and James Roberts. We'll see you next week.